Well, Mike, thanks so much for joining us this afternoon, and the market's certainly liking the kind of numbers you've put through this morning, despite the fact that it's come through at the bottom end of the guidance you provided a couple of weeks back. Lindsay highlighting that, in the commentary, say you're able to put this on the table despite a challenging environment. To what extent do you say that to make yourselves feel better?
Yeah, we do think that they were a very solid set of results in a difficult environment. It's not often that you can report a set of numbers where all of your key performance indicators in banking terms, whether you look at margins, credit loss ratios, return on assets, return on equities, NIR to expenses, all of those ratios actually improved year on year, and all of our clusters or frontline businesses managed to grow their earnings. Just a slight correction, our guidance was actually for headline earnings per share, and we came in exactly in the middle of the guidance that we gave to the market.
Mike, fascinating to look at the state of the South African consumer, and I'm looking at your retail numbers now, and there's been this incredible scramble for the retail customer between all the big banks and some of the sort of second tier, if I can call them that, banks as well. And looking at your numbers, 655,000 new customers, 377,000 at entry level. You've got 1.113 million, I think it is, rich people, 165,000 in the middle segment. How has that changed since you took over from Tom Boardman a while ago? In other words, have you changed your shift to the type of customer that you want?
No, I mean, really what we've been doing is a multi-year journey. Things in banks take a long time to translate into an outcome. We've been very focused on building Nedbank as a bank for all South Africans, on growing our share of the youth and entry-level market, which in many ways is an investment in future revenue growth from a banking perspective. And we've also been very pleased to see how our middle market franchise, which is really the sweet spot in terms of non-interest revenue generation, has been growing.
That non-interest revenue highlighted also your diverse annuity income stream. So talk us through that, because this, to an extent implies that your product offering is also seeing shifts along with your shift in focus on the consumer.
I think that's right. You really have to look at what the underlying drivers are, the outcome of which is a growth in non-interest revenue. So we've been focused on building our client value propositions, Nedbank Kiona at the bottom end of the market or entry-level banking, and Nedbank Savvy as our mid-market proposition. We've been investing strongly in our distribution. In fact, just during 2012, we added 80 outlets and nearly 500 ATMs. So we've been investing strongly in that. We've spent about R1 billion since 2009, and the outcome of that investment is the non-interest revenue growth that you see. On top of that, we've invested in our electronic banking channels, particularly on the wholesale side of our business, to grow our transactional banking revenues, and our Nedbank Wealth business, and in particular the asset management and insurance operations, have done really well. Our asset management business had 24 billion rand of net client cash flows, and in our insurance operations, the data that people look to there would be value of new business up 37% and embedded value up 33%.
Mike, sorry, Sasha, you can go next, but just let me ask Mike about the credit loss ratio, CLR, 1.05%, impairments are what, at 5.2 billion. Lots of talk again about perhaps that increasing as the South African consumer comes under more pressure in 2013, but you seem to have the situation under control. How have you managed that?
We've had a very big focus on both getting our impairment methodology sufficiently prudent, so if there is bad news to be taken, you take that early, as well as our collections environments. I think if we look forward to 2013, credit loss ratio is always very difficult to forecast. What we would expect to see is continued very good performance from Nedbank in the wholesale side of our business. We've had very, very good credit metrics there through many cycles. And I think the retail side of our business will continue to see improvements in secured lending and probably some worse performance in the unsecured lending side of the business.
Mike, you were in Davos recently, and I got the sense that the mood was generally positive on our continent as a whole. Now, where do you see your business over the next half a decade to a full decade in terms of its participation in the rest of the continent, not specifically here in South Africa?
So the way we express our strategy is to say that in Central and West Africa, we have an alliance or partnership approach. And we've now been in the alliance with EcoBank for around about 5 years. And we have the exciting opportunity that transpires in November this year to November 2014, there's a 1-year window where we are able to own 20% of Ecobank, and we would currently intend exercising on those options and top-up rights. So Central and West Africa we would cover through our Ecobank alliance, and then in Southern and East Africa we would both want to increase our activities organically. We already have businesses in Swaziland, Lesotho, Namibia, Zimbabwe and Malawi, and we remain alert for acquisition opportunities in Southern and East Africa that are financially, strategically and culturally sensible for us.
Mike, take us through again the rationale for going this route in terms of a strategic alliance with an African bank like Ecobank that already has that footprint.
So if you look at Ecobank's footprint, it is predominantly concentrated in Central and West Africa. We think that those markets are challenging markets and really do need the benefit of local knowledge on the ground, and Ecobank clearly has that. What an investment for us in their holding company would also bring is significant diversification benefits, because through one single point of entry we'd have access to 33 different countries from an investment diversification perspective. But perhaps most importantly, what it provides our South African customers with is access to the broadest based Pan-African banking franchise for them to transact with as South African businesses grow into the rest of Africa.
Mike, very finally, it wasn't so long ago, I mean only 2-3 years ago, where bankers like yourself couldn't go out in public without having a false beard and a hat, because you were the pariahs of the investment world and the world in general actually. So it's been an incredible turnaround, and I think South African banks have covered themselves in glory actually over that period. And looking at some of these phrases from your results: improved credit loss ratio, responsible expense management, strengthening balance sheet, investing for growth, which is fantastic. But can it continue at this pace?
So certainly if you look at our prospect section, we think that we are doing enough in investing for the future, growing our distribution and growing our client base to enable us to continue to grow our profitability in 2013. But given our outlook for a reasonably muted macroeconomic environment in 2013, what we're saying is that we expect our earnings to continue to grow, and to grow it above our medium to long-term targets, which is CPI plus GDP plus 5, so 5% real growth, but below the growth rates that we saw in 2012 for that metric, which was 19%.